We'll just talk like
Yeah. Yeah.
income is passive income also. So
Hmm.
there's income that you worked for, income that came in passively, and then profit is what's left after expenses in a business.
Yes.
So going forward, if you hear Vinny say the word cash flow, what he's talking about is profit. It's money that we get to
Profit.
keep. It's
So
money that
true.
stays afterwards. Income, which you were just talking about, is money you earn, or it can be passive
Hmm.
money. It's money that comes into the business. It's just kind of the top level. It's revenue. It's that top gross amount. And then flow is the money that has to be spent. It's the money, your
Yeah.
expenses every month are $5,000 a month or
Hmm.
50. One of my businesses, the flow is $20,000 a month. In fact, my rental property business, when I had
Hmm.
what was it? I think we had 60 units and our
Yep.
flow every month was $30,000 a month. Every month flow was mortgages, taxes,
Hmm.
insurances.
Yep.
And I
Yep.
think we could probably even talk about one of the RALs you have, right? So that we know the management of that, we know the taxes and the building and the expenses
Sure.
are flow. And then so that's just money that just always has to be in the account. And then there's equity, the magic component of the difference between the value of your asset and the debt that you hold on it. Vinny, if you could explain before we go back into income, because everyone wants to talk about how do I make more money, and before we talk about making
Yes.
profit, and before we talk about the paying the bills, can you just magically explain equity? Why equity to me is so magical? Why is this guy think it's magical? Why
Oh,
how did it build your wealth? Like,
equity. Equity is the name of the game. What that is actually, when we put down payment, we put, we do closing costs and things like that. When we purchase a real estate asset or stocks or anything, you are putting some money down. Now the value of that asset increases, but the residents are paying down the balance of the loan from the institution. If you're getting a real estate, if we bought $1 million and the institution gave us $700,000 loan, and we over the years we'll be able to increase rents and amenities and everything. The NOI, net operating income, total revenues minus the expenses, is called net operating income. As that grows, divided by the cap rate of that debt, it could be business cap rate, it could be real estate cap rate, right? Any kind of thing. So the value increases. Now, when we say the value increases from 1 million to 2 million, but the loan has gone down, maybe 600,000. It's not 700 anymore, it's 600. So the value, the equity growth, we call it, is the difference of that, the 1 million extra minus the 100,000 lower mortgage. So 1.1 million is the equity growth. Now, let's remember, we did put money down. So that equity, whatever we put down, has grown into such a beautiful return on investment, which is equity gain.
so for each of you who's listening right now, and by the way, Vinny,
Mhm.
excellent example. I love that you also included the debt pay down, the amortization of the loan, because I don't always include that when I'm
Yeah,
talking about it. So that was a
yeah.
little more depth. So a person could invest $300,000, and because of equity,
Mhm.
that 300,000 became 1.4 million because you added the 1.1
That's,
plus the
yes,
300. So 300,000
yeah.
became $1.4 million. That's the magic of equity based on appreciation and amortization, pay down of the
Mhm.
mortgage and appreciation of the asset because of forced appreciation. In fact, you didn't even talk about the market going up. You just said raised
No.
rents, we improved our expenses, and we were able to get this access.